For more on the emerging market sell-off, we're joined by Nicholas Pardini, managing partner of multi-strategy hedge fund Nomadic Capital Partners. Nick, thanks for joining us tonight. Let's get straight into it. The Fed opted to stick with its plan to continue to reduce its monthly bond purchases, now down to $65 billion, regardless of the recent distress in emerging markets. So what impact is that going to have?
Well, the main impact that's going to have is it's going to shorten up capital available for these emerging market countries to make up for their trade deficits. That is the particular reason why countries such as Turkey, India, and South Africa are struggling with their currencies, because they have a lot of local currency outflow to finance trade deficits, which are either from declining exports or over-reliance on foreign direct investment.
Nick, in very simple terms, though, in as basic terms as you can, explain the link between what the Fed here in the U.S. does and why that is so detrimental to these emerging markets.
Well, the Fed provides the needed liquidity and also the interest from investors to take risk in emerging markets. If you hold interest rates low and devalue the U.S. dollar, more investors are willing to take risk in emerging markets where they get a higher rate of return. When it's not as easy to borrow this money, whether for the central banks to cover their trade deficits or for investors, these markets are no longer as attractive, and they prefer to put in safer assets in more domestic markets.
Right, okay, but the Turkish lira and the Argentine peso have been declining since talk about the Fed tapering its bond purchases began last May. So why this major sell-off? Was the trigger the announcement of a disappointing purchasing managers index from China?
That could, for a lot of these countries, that would be part of it. Turkey, that wouldn't be as much. Turkey's problem is more of a political scandal involved with their President Erdogan and corruption and other political instability fears, which make it a less safe place to invest. For countries like South Africa and Brazil and Argentina, the China PMI is more likely a trigger, as they rely on exporting raw materials to the Chinese market.
So, Nick, how bad can this get? If the Fed continues its tapering, how bleak a picture could be painted for emerging markets here?
Well, I don't think it's just going to be emerging markets that are going to lose. I think most of the world's stock markets are going to fall, and I think developed markets may, at this point, since emerging markets have already sold off considerably since last year, underperform emerging markets simply because their stock valuations are at very high levels, propped up by the easy monetary policies of the Fed. And similar to what happened when rates were risen shortly before the housing bust, you could see anywhere between a 20 to 40% correction in developed and emerging markets over the next year.
Wow, a 20% correction in developed markets. That means the U.S. market here as well. Do you think that that may influence the Fed to react to a market sell-off and stop the taper?
Possibly. The thing that they risk is their credibility. If the Fed backs off on its taper now, then the Fed will lose its credibility of taking inflation seriously, and we may have a repeat of the 1970s, where we had consistently high inflation to cover high public spending in the previous decade.
Nick, the central banks of these emerging countries have taken action. Turkey hiked its interest rates, India hiked its interest rates, as did South Africa. Why has this not been working to stem the carnage?
Well, I mean, it's only been one day, but I think with Turkey, again, it's more fears of political concerns versus in terms of the negative real interest rates. But what they can do is they're going to have to do more structural reforms beyond just monetary policy to make their economies more globally competitive and free it up for more investment. That is probably the way that they could fix this. Or the other way is that they're basically their currencies will fall, and that would be another way to make them more competitive. But I mean, emerging markets have been growing so fast for so long; they are due for a slowdown. But on the optimistic side, emerging market countries are starting to now have more favorable valuations, and probably within the next 6 months we'll have a pretty good buying opportunity.
Nick, which one is the worst off? Morgan Stanley coined the term the fragile five, referring to Turkey, Brazil, India, South Africa, and Indonesia. Which one of those do you think is in the worst position?
I think actually amongst the emerging markets, the one that's the worst off would be India. India has the fourth highest current account deficit amongst the major emerging markets at 4.6% of GDP. And India's economic problems are more structural than in terms of just tapering. For example, they have infrastructure that doesn't suit the needs of its growing and large population, such as basic power and utilities and roads to facilitate trade. They also have a lot more political and ethnic tension within the country, which could cause other long-term geopolitical problems in India. I'd say that that is the weakest of the emerging markets. And then followed by that would be Brazil, because of Brazil's reliance on commodity imports, particularly iron ore exports to China, which are going to continue to decline.
All right, we've got more on Brazil coming up after the break. Thank you so much, Nicholas Pardini, Managing Partner of Nomadic Capital Partners.